You won't see it on the front page of the news. There are no tanks, no bombs, no breaking alerts. But right now, a war is being fought that could change the global economy as we know it. It's a silent currency war, and if the balance of power tips, it could reshape everything from your savings to what currency the world trades oil in. This isn't speculation, it's already underway. In the next 10 minutes, we'll break down the players, the strategies, and what this means for your money. Before we dive into what's happening right now, let's define what a currency war is. A currency war, also known as competitive devaluation, happens when countries try to weaken their own currencies to gain an economic advantage, usually to boost exports or reduce debt burdens. The logic is simple. If your currency is cheap, your goods are cheaper on the global market. More exports, more money. But today's war isn't about temporary devaluation. It's about control of the global financial system itself. And this time it's not loud. It's not public. It's coordinated, quiet, and strategic. The world is slowly shifting away from the US dollar, and if that succeeds, it would be one of the most significant financial shifts of our lifetime. Let's talk about who's involved in this silent battle. 1. The United States and the US dollar. Since World War II, the dollar has been the global reserve currency. About 60% of foreign exchange reserves worldwide are still held in dollars. Global trade, including oil, is mostly priced in dollars, giving the US unmatched economic power. 2. The BRICS nations, Brazil, Russia, India, China, and South Africa. This group, now expanding with new members like Iran and Egypt, is pushing for a multipolar world order. They're not just allies, they're actively challenging the dollar's dominance. 3. Central banks and sovereign wealth funds. These powerful institutions hold trillions of dollars and influence the global flow of capital. Many are shifting reserves away from dollars and into gold, yuan, and other assets. These players aren't fighting with weapons. They're fighting with currency reserves, trade agreements, and financial infrastructure. Now let's break down the tactics being used in this quiet financial warfare. 1. De-dollarization. Countries like Russia and China are reducing their reliance on the dollar. Russia now settles more than 50% of its international trade in rubles or yuan. China has launched the cross-border interbank payment system, CIPS, to bypass SWIFT, the dollar-based global transaction network. The BRICS bloc is developing its own payment systems and discussing a new shared currency backed by commodities like gold. 2. Gold accumulation. Central banks are buying record amounts of gold. In 2024, global gold purchases by central banks hit a 50-year high. Why? Because gold is outside the control of any one nation, especially the US. It's a hedge against currency collapse and a signal of mistrust in fiat systems. 3. Digital currency development. China's digital yuan is already live in pilot programs and cross-border tests. It gives the Chinese state complete control and visibility over its financial system, and it could one day challenge the dollar's use in international trade. Meanwhile, the US is lagging behind, still exploring a central bank digital dollar. 4. Trade alliances that avoid the dollar. The BRICS Plus coalition is forming new trade pacts that bypass dollar settlements. Saudi Arabia, long loyal to the petrodollar system, has hinted at selling oil in other currencies, especially to China. If oil is no longer traded exclusively in dollars, it could break the foundation of US global influence. This isn't just geopolitical chess. It has real consequences for the global economy, for inflation, and for your investments. 1. inflation could rise sharply. The US benefits from being able to print the world's reserve currency without immediate consequence. If global demand for the dollar drops, that could lead to higher inflation at home, as imports get more expensive and borrowing gets riskier. 2. Interest rates could spike. Global demand for US treasuries helps keep interest rates low. If foreign governments stop buying or begin selling US bonds, the Fed might be forced to raise rates further to attract buyers, which hurts borrowing, business growth, and housing markets. 3. Market volatility would increase. The dollar's strength has long acted as a stabilizer for global markets. A multi-currency world would bring more uncertainty, volatility, and pricing risk. 4. Long-term US power would decline. Losing reserve currency status doesn't just impact trade, it impacts military funding, international influence, and foreign policy leverage. The US would become just another major economy rather than the anchor of the global financial system. This is why the stakes are enormous and why billionaires, central banks, and governments are repositioning now, before the public catches on. We've seen shifts like this before, though not on this scale. In the early 20th century, the British pound was the world's reserve currency. After World War II, the US dollar replaced it through the Bretton Woods Agreement, giving America dominance for the next 80 years. Now we're watching the early signs of another realignment. But instead of a formal treaty or war, it's being done quietly through gold, tech, and trade. Examples today: Russia selling energy in yuan, Saudi-China oil talks in local currencies, record-breaking gold purchases by emerging market banks, the growing influence of the Shanghai Cooperation Organization and BRICS. The silent war is already being fought. So what does all this mean for you as an investor or someone who wants to protect their future? Here are 3 things you can do right now. 1. Diversify your currency exposure. If all your savings are in a single currency, consider exposure to alternative assets like gold, foreign stocks, or currency ETFs. 2. Pay attention to global trade trends. Watch what countries are doing, not what they're saying. When BRICS nations stop using the dollar, that's not politics. It's a financial shift in real time. 3. Hold some real assets. Whether it's gold, commodities, or productive land, real assets tend to hold value better during times of monetary instability. You don't need to predict the future. You just need to see where the smart money is going and not wait for permission to protect yourself. A silent currency war is being waged right now, and the outcome could change the world's financial system forever. The question is, will you be caught off guard or will you prepare? If you found this breakdown helpful, hit like, subscribe to MacroMentor, and turn on notifications so you don't miss future videos that decode global economic trends and help you stay ahead. This is MacroMentor, guiding you through the bigger picture of money and markets. Stay sharp, stay diversified, and I'll see you in the next one.